We analyze the exchange rate and balance of payment crisis risk in the global development finance architecture. Concretely, we analyze this risk when multilateral development banks lend in US dollar or euros to national development banks for these national development banks to do on lending to investment projects. These investment projects may be export-enhancing investment projects which generate hard currency for the developing country, for example, building a port or developing export agriculture, or domestic-oriented investment projects which don't generate hard currency, for example, a solar panel farm or sewage system. Being from Argentina and experiencing so much foreign exchange stability and recurrent balance of payment crisis, it is also clear that this risk should be considered if we really want to achieve the UN Sustainable Development Goals. In our theoretical model, the national development banks needs to optimally choose the proportion of on-lending that goes to export-enhancing investment projects and to domestic-oriented investment projects. We analyze 3 different scenarios depending on the availability of USD liquidity in the foreign exchange market of the developing country. In the first scenario, with abundant USD liquidity, the National Development Bank may freely choose the proportion of lending between these 2 types of projects, without any need to consider how this decision affects the foreign exchange market. In the second scenario, with normal USD liquidity, the National Development Banks needs to consider how this decision affects the foreign exchange market. Now, the National Development Bank must lend a certain proportion of export-enhancing investment projects so as to increase supply of USD. In the third scenario, with scarce USD liquidity, the National Development Bank is bound by the foreign exchange market and balance of payment problems. Now, the National Development Bank has to choose a higher proportion of export-enhancing investment projects. It is important that both national development banks and multilateral development banks consider these foreign exchange and balance of payment constraints when choosing what types of investment projects to finance. If multilateral development banks want to increase the proportion of on-lending that goes to domestic-oriented investment projects, they also need to be more ready to refinance a higher proportion of the initial lending to national development banks and give more time to pay back their loans. Further, it is important that multilateral development banks reduce the interest rate that they charge national development banks. For example, in the current COVID pandemic, increasing the multilateral development banks' refinancing to national development banks and lowering the interest rate that they charge is key.